Well, it seems like it's been a while since we've done this, but that's just the nature of the test. I don't like to do a lecture and the test. I don't like new material and trying to study at the same time, so we're just kind of compressing on some of the other weeks. First thing, I'm going to run through the test. Then we're going to go through the lecture. We're going to talk about stocks and bonds. And then I'm going to return to talk a little bit more about the project. And we'll spend some time on that. But again, it's kind of that point. People really have a tough time getting going on that. But I don't think it should be that hard if you approach it the right way. All right, so let's look. So the first exam, I think it was pretty straightforward, especially if you did the review. The review will be there for the final as well, so make sure you take advantage of that. Opportunity cost, like I said, some of these questions, if you didn't know that one concept like opportunity cost, or maybe liquidity was another one that just seemed to come up over and over again, because, well, especially opportunity cost, it is pretty important. Again, if you give something up, everything, your time, your money, everything has an opportunity cost, and it's what you forego. So second one on that, yep. Number 3, obviously, time value of money. So, well, like I said, we'll talk about the plan, but your plan, your lifelong plan, really should be to start setting some money aside as soon as possible to save. And again, you're not, retirement, it may be your goal because it's smart to save for retirement because there's tax advantages and it's sponsored by your employer a lot of times and things like that. But big picture is just saving in general. Your retirement, you're going to be living somewhere. So if you have a house and it's a large asset, that's a nice part of your plan and nice part of your perhaps inheritance you may pass along to somebody else. So anyway, if spending exceeds the amount of your income, best option is you got to cut back. You got to learn to live within you can only sell so much of your stuff. You can't work yourself to death, especially as you get older. You're not going to want to work like that, or you have more demands upon your time with kids or just other stuff going on. Second job, people got to do what they got to do right now, especially. I understand that with the inflation and the tough economy, but living within your means is a skill you'll need to master at some point. Liquid asset, so cash that can be made available. So student loans, good example. Long-term liability, so easy in terms of a definition. If it's over a year, it's long-term. If it's less than a year, it's short-term. Measuring your wealth, net worth, assets minus liabilities. Hopefully it's a positive number. What is most important so it doesn't become so high? You can kind of nickel and dime yourself into poverty. You buy a little thing here, a little thing there, and then you have all these fixed payments. It's doesn't give you any flexibility. You end up job locked or locked in whatever because you have to keep your income coming in or you're going to go broke. It's much better to not have a debt level that's that high. Time value of money, and number 9, we know that. Number 10, again, time value of money. Compounding, again, time value of money. So it's a concept that's super, super important. So that's why it's hit numerous times. Filing for taxes, the lowest, taxes are meant, you're supposed to pay as little as possible. That is your objective. There's nothing dishonest about that. Tax evasion is a problem. Tax evasion is, avoiding taxes. Well, not avoiding, it's cheating and not paying your taxes. But tax avoidance, that's why the code exists. It's set up for you to try and pay as little as possible, because again, they've structured the loopholes or the deductions or whatever you like to call them to encourage the behavior that they want you to perform. This lady, yep, held the stock 7 years, so long term, obviously greater than a year. Made 15 grand, so there you go, 15 long term. So you don't need a calculator, and the final will be kind of the same way. there's lots of things that believe me, you may want to use a calculator when you're doing your taxes and stuff, but you also want to be able to kind of calculate this stuff out in your head so you don't make stupid decisions by getting, numbers wrong. So you can do things kind of on the fly. Purchasing credit. So the only thing that's tax deductible is real estate. So these other ones, those are all consumer items. Nope, credit card interest is not tax deductible, or loans on anything else. The only thing is mortgage. That's how banks work. They take your money, they give you less, and they loan it out at a premium. Short-term cash deficiencies. So again, cash, short-term liquidity. Yep, if you can't get it done, you are going to incur finance charges. Stopping payment on a check, only if it hasn't cleared, which is a difficult thing anymore. But it's great for lost checks. Like I say, if you lose somebody's check, or you're not certain about a check, and you have a relationship with the other person, some sort of trust, well then you can put a stop payment on a check. And if you have a legitimate debt and you do a stop payment to screw that person, yeah, you've committed a crime. So that's not going to work. Overdraft protection, keep you from bouncing things, especially if you want to kind of max perform your checking account, not keep excess cash in there. Maybe keep it in someplace else, maybe in cash, but in a brokerage or something, or invested or something like that. But keep tons of money in a liquid checking account is not smart. Valid reasons, yeah, day-to-day expenses are not one of them. You need, again, live within your means. APR, annual percentage rate, gotta review it quickly. And it's also, like I say, you can do some budgeting type things. You can look and see, where did all my money go? And so I kind of like that. Collateral, that's something that's with a secured loan. It's the asset that's going to secure that loan. And it's a positive thing because it can get you a much lower interest rate. So a secured loan, exactly. Don't be a cosigner. Cosigner's responsible. Only what do we say? Except the loaner may not seize the assets of the cosigner. Yeah, they can seize your assets. So you're on the hook for it, and you're probably not the one receiving the mail or knowing the loan's in distress. And then all of a sudden you're going to be blindsided, perhaps. Not a good thing. When purchasing a home, the real estate commission is paid by the seller. So keep that in mind. A lot of times you'll see homes that are only held for a couple of years. All of a sudden they want to charge roughly about 6% more than they bought it for because they want to break even, and they know they're going to have to pay the real estate commission. Expect that to probably go away within your generation. The whole notion of 6%. They haven't come up with a solution yet, and real estate professionals or salespeople do legitimate service, but the 6% thing it's kind of arbitrary. In fact, it is. They can't. It's just an agreement that you set up, and it's almost, I wouldn't say corrupt, but it's kind of a cartel kind of thing where they've all gotten together and decided 6% is what we're going to charge, and if it's challenged, it's a sensitive thing with most real estate people. But most of them earn their money, but make sure they are. Don't just use especially if you're selling, make sure they're earning their percentage. Disadvantage of homeowners association. Good and bad. I'm not going to tell you. Anybody who says homeowner association is awful or homeowner association is great, it depends. They all have their own characteristics. Maybe do some research on the neighborhood you're moving into, or also the situation you find yourself in. If you're in some, very small home sort of situation with zero lot lines, and what your neighbor does really impacts upon you, yeah, you probably want a strong homeowners association. But if you're kind of spread out and don't want to get in each other's business, then maybe not. Fixed rate mortgage, the payment will stay the same regardless. The first year to the last year. So 30 years out, I guarantee you that, especially at the rate we're going at right now, that mortgage amount is going to be much, much less than rent. ARM, adjustable rate mortgage. As interest rates rise, and if people want to buy homes, they may start opting for this sort of stuff again. It's going to be the only way that homes are sold when we get into these higher rates. Do not ignore risk. You can definitely want to avoid them. Maybe use an insurance company to accept the risk or insure against the risk. Kind of almost the same thing. I mean, you should accept some risk yourself, perhaps. Say maybe go without collision if you're in that sort of situation. It makes sense to you. But if you've got a loan on the vehicle, collision would cover you if the accident is your fault. But if you don't have collision and you've got an older car, yeah, you're willing to just suck it up. It's a roll of the dice, but sometimes you've got to use your own judgment and know, kind of do the math over a couple of years. Comprehensive covers all the cats and dogs kind of stuff. So wind, hail, windshields. I would imagine, I think a moose would probably fall in that category. Anyway, it's different up here in Alaska. Deductible. That's the part that you're going to pay. So an easy way to get a lower payment is to accept a higher deductible. So that's kind of accepting risk. Sometimes, though, some of these deductibles with, especially on the Affordable Care Act, on the health insurance, oh my God, the deductibles are a crisis. You have insurance to avoid a crisis, but when the deductibles are $6-7 grand, can get high. Which of the following is not covered by a standard homeowner policy? Obviously, a flood, right? Because a flood, there's probably lots of people on the riverbank, maybe an entire community on the riverbank. We don't see it so much up here, but believe me, I've lived, when I was in the military, it was, anyway, you could tell where the flood zones were based upon real estate prices. And places that were known to flood usually had kind of the poorer communities. And it's really sad when you have a situation like, let's look at Katrina back then. Why were, the poor folks more affected? Because that's the only place they could afford to buy real estate. And some of the rich neighborhoods, they were built on higher ground. So it's kind of a double whammy. The people who can least afford it are the ones that get clobbered. And flood insurance is expensive. So, and it's only a federal program. So it's the federal government still wants to be reimbursed. They still try to do it on making, not just a welfare program, but it has to be bankrolled by the federal government, because the tendency is for a lot of people to be affected all at once, and a regular insurance company would just not have the financial solvency to make it through it. To cover valuable property. So again, if you have certain items that are quite expensive and they're on your homeowner's policy, make sure that they're delineated on there. And so just kind of read through the fine print, talk to your agent if you have one, or look through things, but you're looking for a couple key words like a floater, an addendum kind of thing. It might be called a rider. Anyway, it's something that goes above and beyond the standard contract to cover items in a certain area. Best way to reduce your homeowner's insurance, deductibles again. Health insurance, most people get it through their employer, and it's cheaper for insurance companies to do that as a group. So anyway, that was the exam. I don't think there's too much heartburn. I think most of those questions are pretty straightforward. And it kind of gives you a glimpse of what the final will be like. So, investing in stocks. Why would you want to do it, especially right now? Oh my God, yeah. This might actually be the best time ever, though. If you have cash that's been sitting on the sidelines. If you're already invested, at this point, you just kind of got to ride it out. Stock. What stock is stock is an equity position, which means an ownership position in a company, in a publicly traded company, most likely. Publicly traded companies are ones that are, obviously there are certain companies that have shareholders, but they're in private hands, or they're owned as a some sort of family type business or something. But most large corporations, for the advantages of being able to generate capital, are publicly traded. So New York Stock Exchange, this used to be a bigger deal before we had computerized trading, digital trading, all that kind of stuff. Now New York Stock Exchange, just perhaps it represents a company that's established and productive, but there's a lot of companies, especially in the high-tech sector. I don't think Microsoft was ever on there. Google, most of these companies that I always traded were on NASDAQ, another exchange, which is just an electronic exchange, doesn't have a physical trading floor. But anyway, New York Stock Exchange is still kind of the prestigious one. And the floor traders, not a lot of job security in that thing. If you trade stock, I bought some stock. I guess I did 2 days ago. And again, it's done pretty much instantaneously. There's no person on the floor. No, this was all done electronically. And we'll talk about how you can place orders. It's quite easy. Specialist trader. So maybe if you're a big boy, somebody, a high wealth individual, you might have some individual attention, but frankly, I don't want to pay a commission. And most people don't. Most people don't need that sort of information. If I had somebody give me advice, but somebody just to execute the trade, there's really no value added in that. Typical stock transaction through a brokerage firm executed by a specialist. Other stock exchange, American. I don't know that I've ever had any stock that's listed on American. And then there's all these local exchange, but again, the significance is not such a big deal because this used to be a pejorative term, OTC, over-the-counter stocks. But this is kind of how it's done anymore. Now, what they'll want to emphasize is less stringent. And you do see stocks sometimes delisted from the New York Stock Exchange, which means, it's like a sports team in the UK or whatever, where they're relegated down to a different league, a lower league. But things have already gone wrong if that's happening. But the market makers, the reasons why anything, to include stocks, they sell for a certain price is because there's somebody on the other side that wants to buy it. So that liquidity is what you're after. You're after that volume. So sometimes when you hear, people talk about, there's predators and there's, all this computerized trading and vulture capitalism. Thank God there's somebody out there. When a stock is falling, it'll continue to fall until somebody wants to buy it. Crypto is an interesting category. You could argue that crypto is maybe it's actually a strength that it drops because a lot of people don't want to sell it. Whereas stocks, if it goes off by maybe a few percent or something, there's going to be people automatically dumping it right then. But crypto, if people have faith in, say, something like Bitcoin or Ethereum or something, they might just realize, this is just normal market volatility and it's going to come back. Whereas companies, people may think, this thing's going out of business. We got a problem. If a company goes out of business, your stock, because it's an equity position, it's an ownership position, you're done. You have no claim against anybody because that company went out of business and you were an owner of the company. So that's why there's the concept of diversification and not putting all your eggs in one basket is basically the same thing as diversification. It lends itself to investing in mutual funds or something where there's a collection of stocks. So your exposure is not necessarily in one market or one sector or one whatever. Mutual funds, the sky's the limit. There literally are more mutual funds than there are individual companies listed in the stock exchanges. So mutual funds are a pretty good option for most folks. Electronic communications, yep. After hours trading. Normally stocks, trade during the trading day, and it's actually kind of a good thing to kind of take a breather now and then, but there are ways to keep them trading. No person needed. I mean, these guys, because of the high frequency trading, high speed trading, there's real estate that goes for exorbitant prices because they want shorter connections to the stock exchanges where the actual trading is processed. And I mean, these guys are doing digital trading. Things are going at, electricity flows at the speed of light. So when it makes sense to have a facility that's a few hundred yards closer, you can tell how fast these guys are trading. And sometimes you get some of these exchanges like Robinhood and some of these other guys where they do some scammy things where, again, allegedly, I don't want to get sued here, but sometimes if you're placing an order, they might actually theoretically drive up the price. I'm not saying Robinhood does that, but the concept does exist where that could happen. Price quotations, the internet. You can get real-time quotations. There used to be a concept of mainly delayed quotations because they felt that they could sell real-time quotes. Stock brokers, I haven't used one in many years. And I don't think I ever found an honest one the whole time I was doing it. And it wasn't so much the individuals, it was the companies they worked for. I was overseas at the time, and I was looking for, advice on some stocks, and they offered me advice, and go figure, it turns out that they had positions with that company, meaning that, anyway, the pattern of events was I'd buy the stock price would start to dip a little bit. I'm going, what happened here? And then about 6 weeks later, I get a letter from some other lawyer saying there's a class action lawsuit because I wasn't the only one. And anyway, I never followed up on it, but I just quit using stockbrokers. And now stockbrokers for individual investors have kind of gone away because they were charging commissions, and most any brokerage firm now is zero commission because it doesn't cost them anything. You do it all electronically. There doesn't need to be anybody in the pit. Financial newspapers, that's not where you're getting quotes anymore. Financial newspapers, they still have value in terms of giving you advice on performance of companies, but quotations, the information is so dated by the time that paper's printed. I don't even know if they're doing it anymore. Anyway, they'll give you information, and I'll show you a far better method. This is how primitive it used to be. Now everything's interactive charts and graphs, and we'll go there after we talk about the other category. Sorry, I still have persistent cough. We'll look at some of these things. So high and low over the year. So stock symbol, you'll hear this referred to as a ticker because it used to come out on a ticker tape. This is the full name of the company. It looks like normally a ticker would be, say, your Ford. Well, Ford's been around a long time, so Ford's ticker symbol, what you'd look for a quote, is F. I mean, that says something about the company itself, that they've been around long enough where, that's like having a great domain name on the internet, where it's just a single word, or an email address that has, like Jim@Gmail or something. You had to be around in the start to get that. Yield, we'll talk a little about that. Price to earnings, volume. volume is kind of a key thing. Sometimes you'll see some massive price swings, like right around Christmas time. You'll see the price go up and down, but you have to look at the volume. Sometimes nobody's there. Everybody's off on vacation or whatever, and it's that scenario I was describing where something is only worth what somebody is willing to pay for it, and there's so few people in the market. Sometimes you have some rather large swings on as you get near holiday periods. On the actual holidays, the markets will be closed, but as you near, especially around Christmas, you'll see some big swings. Close, that's the close of the previous day. I don't have a whole lot of interest in that. I want instantaneous data. So again, this stuff's getting changed, and it was up 27 cents from the day before. So looking at a stock like this thing's down and almost down to its low, within 60 cents of the low, and the day before it was at 49.67. So this stock right now is kind of depressed. Something brought it down. Okay, no more coughing. Try and get a cough drop here. What else do we got? Anyway, I'll show you a chart that makes this so much easier. Selecting a broker, again, brokerage is probably more important, but even a brokerage, this is really selecting sources of where you're going to get your information on stocks. I've subscribed to some services, and again, any information you get for free is usually worth what you pay for it. So, and there is a concept called pump and dump, where people who own stock will really try to hype it up to drive up the stock price when they already own it. Benefits them greatly. So the internet, you can get, it's basically propaganda, and you can get in some trouble, especially out there on some of the message boards where you'll hear people talk about a stock going way up, and they don't disclose that they own that stock, and they're hoping for it to go up. So if you can, whatever, some people might be offended by the language or some of the other aspects of Wolf of Wall Street, but that whole concept of pump and dump is pretty well illustrated in that movie. Brokerage commissions. So again, this information's getting more dated. Everybody's a discount brokerage firm. Full service brokerage, if you're a high wealth individual, you might have somebody holding your hand and you pay them, but for most of us, not so much. If you do want to pay somebody for advice, again, you're looking for somebody who's going to give you, you don't want somebody giving you advice whose commission, whose livelihood is based upon you buying stuff. You want somebody who's going to give you advice based upon sort of a fee-for-service model, whether you pay them a subscription for, in bulk, or maybe you want good individual advice and you pay that person as if they're a lawyer or something else, a few $100 an hour to give you advice. But they don't make money just because you buy and sell stuff, because that, again, Wolf of Wall Street will kind of talk about that, about the whole churn thing, where they always want you buying and selling, because that's where they make money every time you buy or sell a position. So ticker symbol, buy or sell, number of shares, nobody cares anymore. I bought, literally, it was a penny stock, and I bought fractional amounts. So, I wouldn't recommend penny stocks. Don't do that. But, yeah, what did I do on Friday? Market order, stop orders, limit orders. So what happens is when you go to place a order in the stock market, it is a little scary, but the normally trades are executed quite quickly. I mean, instantaneously almost. And so if something's trading at a specific price, you put in your order, and 99% of the time, you're going to get very close to that same price, if at not that price. But there are occasions on slow times or when there's not, much volume, that your offer may stick out there, and now the price you pay may be a bit higher or lower, since you've got an open order out there waiting on somebody to fill it. So if that makes you uncomfortable, you can do, and that would be defined as a market order. If you don't want to do that, you can do a limit order. And so I actually did this on Friday just because I was unsure, and I wasn't trading vast amounts of money, but it was trading for literally like 11 cents or something. And so I put in a order to buy at no higher than 12 cents. And sure enough, it executed at 11 cents. It doesn't mean that I'm going to actually pay that higher amount, but by using a limit order the way I did, and don't worry if this is it's not that complex, but if it's too convoluted, this won't come up on real life for most of you. But I put in a limit order structured so that it would not trade any more than 12 cents. But I used to do this all the time with Twitter. I haven't traded Twitter in a while, but I'd say 4 or 5 years ago, I found Twitter going in this range between $30 to $60, and it just seemed to just oscillate between those two figures. And so I would buy, I'd have a buy order set for $30, and bada bing, I'd buy, whatever number of shares of Twitter, about $3,000 worth or something. And then I'd just forget about it, and I'd set a sell order at 60. And, once in a while on the phone, I'd get a message, you just sold Twitter for $60. And so I'd, the next day or two, I'd set in a buy order for 30. And then sometimes a week, sometimes a month would go by, and boom, you bought at 30. I mean, it was really that volatile there for a while. And so I was, not making huge money, but I was making money just by playing that volatility swing. And those limit orders were quite useful. A stop order, this is kind of cool. Stop orders, trailing stops. What happens here is, let's say we're doing the same Twitter stock, and it's climbing to 60, but, there's some sort of something in the market that makes me think that this may be the end of this oscillation. Maybe this stock is just going to keep climbing. But my rule of thumb is to sell at 60. Well, what I can do is I can put in a trailing stop. And this is not something because I had some special account. You could do this on day one when you open up an account if you chose to. Anyway, I'd set up a trailing stop, and I would wait till the stock price, in this case I think it was like 63 or something, and I thought maybe it's going to go higher. So I set a sell order at 60, but it was a trailing stop. So what would happen is, and I had it, you can do it by percentage, you can do it by dollar figures, you can do it by whatever, but I had a trailing stop that was set, in this case, about $3 below. That may be too close. People may want to, again, a lot of technique here. It can get real fun. You can make a larger stop, much larger. Most people would do that. But anyway, in concept, it would all work the same. So I've got the stock price is at 63. I've got a trailing stop at 60. If the stock price happens to drop back down to 60, goes below 60, all of a sudden that trailing stop that's set at 60 becomes an order, becomes a market order at that point, and my stock is going to sell. So that trailing stop now became a market order, and I'm going to get out somewhere around 60. If that stock Twitter goes up to say 65, then my trailing stop incremented up and followed that new price, and the new price was established at 65. So now, if Twitter stock drops below 62, my order, my trailing stop becomes a market order when it hits 62. So in essence, that trailing stop kind of ratchets behind the stock price, and it establishes a new floor each time there's a new high. So you can see how this stuff can be kind of fun, and it gets kind of powerful, and that's why sometimes trading individual stocks is not a bad thing, because it does, you kind of, I don't want to say it's like betting at the track, but it is pretty fun. It does get you, kind of in tune to how these companies are performing, and as long as you're not losing, money, as long as you have these trailing stops and other preventive things set up, you can maybe do quite well. I wouldn't have all your money in this sort of strategy. I would still have the most of it in mutual funds and things. But if you're trading some stocks, it definitely is going to provide an incentive to you to save money so that you can, get in the game and stay in the game. Anyway, so stop orders, I hit that as well. Stop order, an order for a brokerage firm to buy a stock when the stock hits a certain price, or a sell stop was what I was talking about. An order for a brokerage firm to sell a stock when the price falls. And that's just a basic one, but you can do it, again, with percentages, and you can do the trailing stop where it edges, where it follows it. Placing an order online. Low commission a couple years ago became no commission. And online, they act like that's a new thing. That is the only way. I don't know if you would actually, I wouldn't even know who to call anymore to place an order. I haven't had a broker in so long, and I think they've kind of gone away. And if they do, it's like when you try to make an airline reservation over the phone, they're going to want a little something, $25 or something to, do what you could have done yourself. They've got to provide some value other than just processing the trade. I can actually do that better myself on my computer. Most people are graphically oriented, so I'm more comfortable with that. If I'm paying somebody a fee, I want a little value added. Buying stock on margin. You can buy a lot of things on margin, to include real estate. Buying stock on margin just means buying it with borrowed money. But this is certainly not for it's just not, we're getting into speculation. What happens is when you buy a stock on margin, so the Federal Reserve, pseudo government agency, sets the margin at 50%. So you can only finance half of it. But the margin call, that's when your Federal Reserve sets your margin at 50%. Well, that price is denominated in stock. So I don't know what Ford is trading for right now, and I don't like Fords. I don't try Fords, but whatever, that's a sample I picked. So let's say Ford is trading for $100 right now, which it's not. It's not that great, but let's say it's trading for $100, and I buy, say, $2,000 worth of it, but I buy it on margin, so I only put down $1,000. So I'm right at the margin limit right now. Well, the problem is my margin is defined under Ford stock. And the stock that's worth $1,000, if Ford stock goes down at all, I don't have the margin required. The margin needs to be 50%. And because the stock price went down, I no longer have the margin. So then I get a nasty call or an automated message just saying, you need to put more cash in there. You need to buy more of this Ford stock to get your margin back up to 50%. And if the stock price falls more, you're going to get another call, and they're going to say you need to get that amount of stock held is denominated in dollars. You need to have $1,000 worth of that Ford stock, and let's say Ford stock dove to $25 or whatever. You need to buy a whole lot more stock, and if you can't come up with the cash to do it, Well, there's an easy solution to this that's going to be automatically executed, and that's going to be sell that stock. And if it's a margin call, it's going to be sold automatically without your intervention because you agreed to it when you bought the stuff on margin. So you can get stopped out at the bottom. It's just the worst case. Your ability to ride through some turbulence is diminished or eliminated by the fact that you're not going to make the margin call and the stock's going to be sold involuntarily. So don't do that. I would also add in this category even more so, don't buy crypto on margin because the same thing's going to happen. Now, real estate transactions, everything's on margin. You always use borrowed money for the most part, but real estate doesn't go out of business. It doesn't go away. It can have its dips, but it's not going to be an issue. And there's not going to be a margin call on real estate. You're just going to see your price go, down, but the mortgage company's not going to say, hey, you need to increase your down payment or something goofy like that. Selling short. Now we're getting again into speculative type things. It's a good concept. I don't know if you remember some of the meme stocks. I did sell short. What was it? United Artists and GameStop, I guess, was the other one. I didn't actually sell short on that. I sold short on Tesla back in the day. And again, I made a little bit of money, and it had to do with an election, and Tesla was sort of struggling back then, and it was sponsored by a lot of government programs, and I thought that the administration that was coming in was not going to be as supportive of some of the subsidies paid to Tesla, and I expected their stock price to dive after the election, and it did dive a little bit, and I made just a small amount of money. But all you're doing is you're selling you can sell short, you can puts and calls or what they're called. But anyway, let's in the Tesla example, when you're selling short, I bought the stock at today's price because it was a short sale. I was not going to pay for it until some date in the future, and that date in the future I would pay at the current. I'd say I bought 100 shares of Tesla today, but I wouldn't pay for them until, let's say, 90 days out. And when I pay for them, I would pay at the then price, the future price. So anyway, it can be a little bit more complex. I'll try and find a better example where I can show you. There's also things like futures trading and options trading. Options are not necessarily bad. Options, you have the right but not the responsibility, and a lot of times they're tied to futures contracts. So let's talk about a futures contract just quickly. Let's say you're an airline. Let's say you're Alaska Airlines, and you're selling airline tickets for spring break of next year. How does Alaska Airlines know what fuel is going to cost in next spring? They can't really forecast that very well, but they want to sell the tickets right now. So Alaska Airlines' core competency is flying, not necessarily, having economists price out fuel. So, and they want to have fairly good certainty that they can offer their tickets at a competitive price, and the price uncertainty regarding jet fuel prices next spring is not something they can deal with, because they want more fidelity, more certainty in their pricing model. So let's say jet fuel, it's not a whole lot different than diesel, Jet A, all that stuff is kind of the same product. So let's say it's trading right now for $5 a gallon. What somebody will do, a company like, and this happens in sugar, if you're a big bakery, it happens in timber, it happens in all sorts of different commodities. But let's say, and it can happen with stocks as well. You can do futures, but it's easier to understand in commodities. So let's say Alaska Airlines, they say we will take 1 million pounds, because jet fuel is actually done in pounds rather than gallons. But anyway, we'll take 1 million pounds of jet fuel. We'll pay $5.25 for an April 2023 delivery, and they put that out there. So there's financial people out there who will go, speculators who will say, well, jet fuel right now can be bought at $5 a gallon. We think prices are maybe going to go lower, or stay the same. Right now, we can lock in their price at $5.25. That's what we have to deliver it for. We'll basically take that bet, and so, boom, Alaska Airlines pays now for that fuel at a million pounds at $5.25. Well, I'm using pounds and gallons. I actually gave you a per gallon price, but you get the concept. Anyway, they set in a price that's probably slightly higher than the prevailing price, and if everything stays the same, that speculator is going to make 25 cents per unit on that. If the price jumps up to $7, that's going to be very painful for that speculator. If the price drops down to $4.50, he's going to make some good money, and Alaska Airlines, could have done better by not selling a futures contract and just buying the fuel at market price in the spring. But again, that's probably not their core competency. They don't want that sort of exposure, so they lock in a price. So futures contracts are very useful to industry, corporations who want to set their pricing and take some of those variables out of the equation. And again, manufacturers will often do contracts. And if you are the speculator who guaranteed that April delivery and that price goes up, that is going to be a very painful situation for you, because you have the obligation, you have a financial, legal obligation to deliver that fuel. So if you ever hear anybody talking about futures contracts with stocks, that's what they're talking about. You can do it with commodities. You can do it with all sorts of investments. There's all sorts of vehicles out there. Now, if, let's say, options can be used that same way, but the difference would be an option would not work for somebody like Alaska Airlines, because that guy on the other side would not have the responsibility to deliver. So an option's more useful to think about it in terms of real estate. Let's say your neighbor's got a house and he's not selling it right now, or you don't have the money right now, and you basically contact him and you say, I know you want to sell your property for whatever, $300,000. I want to buy basically an option to buy that house for $300,000 6 months from now, and I'll give you $5,000 for that understanding, for you agreeing not to sell to anybody else and to sell to me at $300,000 6 months from now. But it's an option. So if I choose not to do it, I don't have to buy the house for $300,000. But guess what? That $500,000 was, or the $5,000 was a premium I gave you for that right to buy that option. So I'm losing $5,000, but I have the right but not the obligation to do that. Anyway, it can get, trading in options, trading in futures contracts can be very, very complex, because there's a whole different set of terminology, and you can do this with it goes well beyond what we're talking about here in terms of personal investment. But if you go down this rabbit hole and you really have an interest in it, it can be quite interesting, because you can take options to buy stock at a certain price in the future. And let's say, Tesla, I don't even know what it's trading for right now. Let's say it's trading for $600. You could buy an option if it's offered out there to buy, Tesla at $600 6 months out in the future. And I shouldn't be using the future, but 6 months from now, at $600. And let's say, and you would pay a premium for that, for that, for somebody to accept that contract from you. And let's say Tesla price went up to $800, and you had this option to buy it at $600. Well, that'd be a great deal for you, right? Now, if Tesla prices drop and Tesla's down to $500, and you have the option to buy it at $600, well, you're not going to execute that option. You're just going to let it expire worthless. And so, anyway, and then you can trade and buy these things. You don't have to take it out to the expiration date. And you can do the same thing with futures contracts. But again, futures contracts can be quite scary, because the downside is unlimited. And the upside is, well, it has more limits on it. All right. Maybe I lost a few people in there. We're talking about short selling stock. Maybe you understand that process. Again, if you paid attention at all during the whole, what was AMC and GameStop, that whole thing where people were selling the stock short. It's a complex technique, but it can be quite profitable. Technical analysis. So when people are analyzing stocks, you will look at people who just look at patterns on a sheet, and they'll talk about, candlesticks and this and that and all these patterns, and it's completely divorced from the performance of the company. So I've never been a huge fan of technical analysis, but there are people who just swear by it. For me, I've been more in the fundamental part. More of like Warren Buffett is kind of a fundamentals guy, where he buys companies that he thinks are going to make money based upon how they're set up. Like his Berkshire Hathaway, they owned all the consolidation that took place in like the cowboy boot market. He owned Justin and Tony Lama and all that stuff. I know there's some other companies out there, but a lot of them were owned by Warren Buffett, because the guy's from Omaha and he sees people wearing boots all the time, and he knows they're going to have to get these boots somewhere. One of his best trades was he owned the trains, the CSX, their corporation, because again, when he's against pipelines, well, that's kind of disingenuous, because if the oil isn't shipped on pipelines, it needs to go on his trains. And with all that fracking, there was no way the pipelines were going to get done in time and have the volume. So a lot of that fracking revolution, all that oil had to be shipped somewhere, and it was on his train. So he made a bundle on that. So some of those things that you can reach out and touch. He would not be somebody who would probably be speculating in Twitter like I was, because it's just tough to understand. Why is the value of Twitter what it is? Who knows? It's just out there in kind of the ether. Yeah, I usually rely on, again, if you're going to do this full time, you can get to a certain point. You can do some rudimentary evaluations, but for most part, you're probably better off looking at some of the third-party comparisons, and you want to look at similar industries. Like comparing, again, Ford to Twitter would be kind of meaningless, because the way those industries operate is completely different. So when you're looking at a balance sheet and an income statement, if you're going to compare, within the industry, you might want to look at, Ford versus GM versus Chrysler versus whoever. I don't even know if Chrysler exists anymore. I think they're mainly Italian. But anyway, make sure you're looking at like information. Now, the information and the knowledge that can be gained from the brokerage companies is pretty amazing, and we'll look at that again here in a second. Stock performance. So it's always future looking. Different people, will use different methods, but a company that I bought in quite a bit of was Lululemon, and I did pretty well with that. I mean, and that was kind of, again, fundamental analysis. I was teaching at UAA. I'm seeing every student out there with, Lululemon bags and the rest of it, and knew a little about the company and the quality of their products, and they did well. Accounting fraud, that's always going to happen. Enron, WorldCom, there's always somebody. Bernie Madoff's. Now, the economic growth, and right now we are in a rough time. Are we at the bottom? I don't even think so. One thing that's going to happen, though, and not to get political, but it looks like we're going to be in a situation where the leadership is split between, say, the president's going to be a Democrat and the House and probably the Senate are going to be Republican. The economy typically does pretty well in those situations. They like that split nature. It's you can attribute it to a lot of things, but the most part is the government is less active. They have less cooperation for massive spending bills that typically don't do well for the economy. GDP, physical. So GDP is the total of all the value of put out by a certain country. Fiscal. So it's somebody who completely doesn't understand personal finance will say physical. No, it's not physical. It's fiscal. So anyway, and that has to do with how taxes, corporations, the way it spends money. It's a competitive world, but just the same, United States especially, when however the saying goes, when the U.S. sneezes, the whole world gets a cold, and it's tough to have one economy surging while the other ones are not. Interest rates. Yeah, they would like low rates. Certainly in the high-tech sector, they do not like these interest rates being higher. And the federal uses monetary to try to influence, whatever term you want to use, but they're hiking the interest rates right now to try and control inflation. And so that all gets back to this monetary policy. Supply of funds. So much money was pumped out in relation to COVID and other things that most people felt that was going to lead to inflation. And apparently they were right. So, CPI. Changes to the CPI do occur. So, the inflation rate of today is not exactly the same as it was back in the 70s. It's probably a bit higher. Producer, this is more some of the raw materials. And things like diesel fuel are just eating this alive. So, it's a tough economy right now. But, man, if you had the cash on the sidelines, there's going to be a certain opportunity to get in. So anyway, you don't want to do anything just with a single source, a single data point. You get some idea that, oh man, Lululemon's a great company. Well, back it up. Generally look for a couple, 3 other sources. Look and see what they're saying about the company. Look what the trends are within the industry. Look and see if there's anything unusual. The Lululemon guys, they had a CEO who was like, the original CEO was kind of out to lunch. He said some very politically incorrect things that had they been widespread or had they not dumped them, it would have definitely affected that company's price, share price. Factors that increase. Yeah. Again, a good product, a company that's well run, but it should have some logic to it. Yeah. Again, favorable attributes are reflected in the stock price. You don't necessarily, like trying to, where we're at right now, trying to guess where the bottom is. They call that, well, first in general, that's called market timing, which is very, very difficult to do. And then the other part is when prices are dropping, trying to guess where the bottom is. They call that trying to catch a falling knife. Obviously, that can end up very badly. Poorly, badly. Anyway, not good. So we'll talk more about stocks. I mean, again, I'm not trying to get you to be some expert in trading stocks, but it does help when you're buying mutual funds and other things that are comprised of individual stocks to know how things operate. So it is useful in that sense. You don't have to, you might, get into the stock market with just a few $100 just to kind of play around and test some things out. But I would not recommend putting a vast amount of money in there. But the knowledge you'll gain from learning how to interpret financial information and understanding how some of the terminology will make you a better mutual fund investor. Because when you're doing mutual funds, you're very much separated from that individual trading atmosphere, and you may lose sight of what's driving prices. And it may save you a lot of money because people tend to panic in down markets, and a lot of times it's just better to ride it out unless you had some premonition and got out at the top. You definitely don't want to get out at the bottom. Bonds. So bonds, how they differ from stocks is bonds they don't represent an ownership position. They are not equity. Big corporations and municipalities and other things, obviously, cities can't sell stock they can't sell equity in their town because obviously people who own real estate there would not be happy. But big corporations, sometimes they don't want to sell stock. They don't want to dilute their ownership interest. They don't want anybody else involved. So all they want is money. They just want to get a loan. But banks don't have that much money, and most commercial banks, they don't operate in that means, or they're just too expensive. Corporations will often find that they can get a lower cost for the money that they need by issuing bonds. And so what they'll do, just in a simple example, let's say they do a bond offering where they're selling bonds, say $20,000 bond with a 10-year maturity, and they'll pay you 4% every year on that bond. So that means you as the investor, give them 20 grand, and then they give you 4% of that 20,000 every year until the bond matures at 10 years, and then they give you your initial investment back. So in the interim, you've got all those individual bond payments, and then you get your money back. Now, with the time value of money, your money is not worth what it was when you gave it to them, but you did get all those payments. And then also, because bonds can be traded just like anything else, you can sell that bond on a secondary market to somebody else. You can say, okay, I've had it 2-3 years or whatever number of years, and I want to sell it. Now, the price that you're offered for that bond on the secondary market is going to be different than what you paid for it based upon what the current bonds are being offered at. So let's say it was a $10,000 bond and you bought it at 4%. Well, because of inflation, new bonds are coming out and they're offering 6%. Well, nobody wants to buy your stinky 4% bond. So they may offer you $9,000 for it. Or let's say the opposite's true. You bought your bond now, it's worth 6%, and a year from now, interest rates have gone back down, and the new bonds are only offering 4%. They may offer you $11,000 for it. So the price that you sell your bond for in the secondary market can change as well. Now, what won't change is if you keep the bond to maturity, you will sell it for whatever. You'll get the money back that you initially put into it. So you'd get the $10,000, but you had to endure an interest rate that was either lower or higher throughout that whole time. So anyway, long-term debt securities issued by government agencies or corporations. Par value, so that's the face value. When I'm saying the $10,000 thing, that's where that one number comes from. Most bonds 10 to 30 years, so there you go. Issues make interest payments to repay par value. Yep. A call feature. Call feature is not a good thing. A call feature doesn't benefit you at all. Let's say you bought this bond that's paying 6%, and all of a sudden interest rates go down, and they can issue and sell bonds that only pay 4%. Well, if there's a call feature, the bond issuer may say, guess what? We're giving you your $10,000 back. Here's your money, and your 6% payments stop now. So it didn't benefit you a bit. Convertible bonds that can be traded or converted between stock sometimes could happen. I currently don't have any bonds. I have done short-term bonds before. Back in another high inflation time, it made sense. I was getting 8%, which was pretty darn good on a short-term bond. But there's a lot that goes into bonds. Bonds, the strength of a bond is the bonds are rated. Stocks don't really have a rating type thing. But because bonds don't have an ownership position, they represent a loan. So there are companies that rate bonds. So you hold it to maturity, yep, you'll get that par value. Coupon rates, a lot of terminology here. Don't get too wrapped up in it. You can get back into some of the details. Investopedia might be one thing to help you out. But again, if you sell it early, yeah, it depends on what the interest rates are, current interest rates are. So selling it early would be selling in that secondary market. Change in response to interest rates. T-bills. So these loans, when they're coming from the government, they're backed by the full faith and credit of the federal government. So there's not a lot of risk there. So the interest rates are going to be quite low. And so in an inflationary time, anyway, your money's going to be inflated away. It's the buying power is not going to be what it is. So I've never held much in T-bonds, T-bills, but yeah, they're easy. They can be sold in the secondary market. They're liquid to that extent. Municipal bonds. Sometimes people are really excited about these because they see the tax-free part. If you're on a high tax status, might be useful. If you're not paying much in the way of taxes, lower tax bracket, less useful. Just because something is paying tax-free interest, you need to do a bit of math to figure out which one's going to be in your best interest, and I'll show you an example for that. Corporate bonds, so that's the one I was talking about. Subject to default risk. Municipal ones could be too. I mean, if you're taking municipal bond from somebody like Detroit, or I guess it was Vallejo in California, and certain municipalities have gone under. Bonds when they're high yield or junk bonds. So obviously the person selling it to you is going to call it high yield. The person who's going to evaluate it is going to be calling it junk. But anyway, smaller, less stable. Default. Default means that even though this thing pays 10%, well, it's only 10% if you actually get the money. If they don't pay it, then they've defaulted. So quotations on bonds, again, you can look them up on chart data. Is usually quite a bit more useful than this tab data. So I talked about this. If the interest rates raise, depends what you've got. You know, it's all volatile. So you can get capital gains just the same. So just a quick example. I'll just run through one real quick. I mean, you can kind of do it in your head. If somebody says, I will pay you 10% interest on a bond that's fully taxable, or you see a municipal bond that says, I'll pay you 7.2% on a tax-free bond, which one do you want? And it's not, you can't just say, oh, I want the higher rate, or well, you want the highest rate, but do you want the taxable bond, or do you want the tax-free muni? And again, these interest rates I'm quoting here are a little high. Nobody's paying quite that yet, but maybe they will in the future. What you need to know is what your bracket is, how much you're paying on your personal income tax. And so let's say you opt for the 10%, you know, the fully taxable yield, and you make, say, $100 of interest income. Okay? Let's say you happen to be in the 28% tax bracket. That means $28 out of that $100 is going to go to taxes. So what's your overall return? $72, right? Which, when you invested $100 or $1,000, whatever, you can see the way I set up the example using 28% and using 7.2 untaxed or 10% fully taxed, that those numbers are going to work out the same because of your 28% tax bracket. If your interest on your tax-free investment is going to be $72, and big whoop that it's not taxed because it's at a lower rate. It's only at $72. Your interest rate was lower, so you made $72. Whereas the other one that you made 10% on, but you gave away $28 worth of tax, so again you made $72. So you have to know what your bracket is. If you're a struggling, making 50, 75 grand a year, you probably don't need to buy the tax-free muni because your tax rate is not going to be that high. If you're somebody living in California and killing it, making good money, and your tax rate is effectively 63%, oh yeah, you want that tax-free muni. So it depends on where you sit, and that's what makes the difference. So time value of money, yep. Everything incorporates time value of money. Risk from bonds, yep, that somebody's not going to repay, the default risk, or that the interest rates may change. Now, to find out the financial health of the company, Moody's, Standard & Poor's, people like that, Fitch, there's other companies that will rate bonds. And keep in mind with bonds that it's like uber great inflation. An A-rated bond is not that great. AAA, is better. So you get down in a B category, which, give me a B. That's not a bad grade. That's almost junk. So the letters are a bit deceiving. Same is true with everything. Risk to risk premium. If I'm not saying to be risk adverse, but if you are putting up with some risk, you should be rewarded for it. What you don't want to be doing is thinking you're in a safe investment and finding out you're exposed to a lot of risk. And this does happen with bonds. The whole mortgage-based securities thing, where people had these collateral debt obligations where they had crappy mortgages and they put them together in a bigger pile, and it was all crap, but because it was in a bigger pile, they didn't think it was crap any longer. They thought they'd lost sight of what the underlying assets were, and the underlying assets were crap, and putting it in a bigger pile just made a bigger pile of crap. So here's what I was talking about. Down in B range is actually into the junk range. So Standard & Poor's, Moody's, different agencies. These guys don't sell stuff. They're rating agencies. So you'll find this, every segment of investing has their own little group of people who evaluate stuff. For mutual funds, it's Morningstar. For insurance companies, another company. For bonds, Standard & Poor's, and Moody's. We talked about a call. We talked about the interest rate risk. And especially in a longer bond, there's more risk involved. Short-term bonds, like I said, those are the ones I owned, and it wasn't such a big deal because they were only 3 to 6 month long bonds. You can stagger them, you can ladder them, where you're going to get your money back. People will set these things up to perhaps pay for their child's tuition, so they'll have that bond coming due, a 20-year bond when their child was just born will give them some money, midway through the child's college career. Anyway, for the most part, bonds were not a great investment because interest rates had been historically so low for a while. Now everything's in flux. But bonds don't do well in uncertainty. Neither does the stock market. So there's not really a great investment right now. Yeah, here's what I'm talking about with maturity matching. Where you're going to get that lump sum back. Alrighty, so we hit that pretty well, I think, stocks and bonds. Now we're going to look at the personal term project. So if you're really having a tough time getting started here, I think you might want to set up a draft and kind of look at these things as maybe sort of a checklist initially. A checklist is not going to pass for your term paper. You're going to have to kind of weave it together with some, and make it a little bit more of a term paper, of a story. But in order to look at the different items, you could sort of bulletize these things and look at the different aspects. So big picture is what you're doing is you're trying to set up a situation that's close to forecasted to be similar to what you're expecting in life. I don't want your definite personal details. You can say a guy named Bob or whatever the name you choose, who looks like what you expect your financial and the rest of your life to be like. This whole 5-year forward thing, that kind of confuses some people. What I'm trying to say is if you're struggling going to school right now, you're delivering pizzas or doing DoorDash or Uber or something, and you're not making a ton of money right now, you're focusing on school. I'm not saying you got to get in the weeds and talk about your life insurance from this point right now. No, you're obviously going to college to do something more, or maybe you're already you're already immersed in a career and you're going back to college. So maybe it does make sense to use right now as the time to set your term paper. But in any case, put yourself in a position in your life where you're in your career or starting your career, okay? And then look at the different aspects, the financial aspects of your life. And I'm not trying to get into your personal stuff, but you kind of have to make a guess. Hey, I'm single right now, but I'm anticipate, meeting whoever, and perhaps there's going to be children involved, or perhaps I'm going to be doing this or going abroad or doing whatever. Perhaps I'm going to be leaving Alaska, or maybe, obviously it's a distance. Maybe I'm not even in Alaska right now. I'm where I'm at. So anyway, there's a lot of changes probably coming. So you're kind of taking a stab out there to forecast the most likely scenario that your life is going to be taking, and then you're going to make some sort of financial decisions based upon different things that you're going to have to choose. What's going to happen is, if let's say you're a typical student, you're going to go to work for some big soulless corporation here in 3 to 5 years, you're going to walk in that first day and they're going to have typically what's called a cafeteria plan, and they're going to say, okay, yeah, welcome to the company, and these are your health options, choose one. And here's all your retirement options, choose one. And they throw all this stuff at you, 4 or 5 plans. And you just started with a company. You don't want to be, well, this doesn't seem right, or I don't understand this. You want to act like you kind of know stuff, and you want some time to think about it. And typically they will give you about 30 days or something to make your decisions. But once you make those decisions, they kind of stick with you. And so it does kind of help to kind of turn this to kind of have a idea of what you're going to be up against before you face it. So if you know a little something about mutual fund companies, or maybe even have a preference for a certain company, or you understand some of these terms like a 401k, or should be a 403b type of their thrift savings plan for military people. You understand a little bit about insurance. You understand that I do need a retirement plan because Social Security is probably not going to work out for me the way I want it to. Just a lot of decisions you're going to be faced throughout the course of your life. What you're going to do in this term paper is kind of make a forecast and sort of a plan. So getting back to how to wrap your arms around this and make it into a 4 to 5 page paper is maybe to look at these different items and then go to a place like, pick your company. You could type in Vanguard, you could type in Fidelity, you could type in T. Rowe Price, you could type in a whole bunch of different companies. I kind of like Fidelity, and full disclosure, I have an account with them, but I've got an account with quite a few people. But anyway, they go through here and they'll talk about some of these items, life events. Like, let's say, I keep hitting this thing. Oh, well, kids are probably going to be in the future, and this is what I'm looking for. Personal finance. Don't get divorced. If you want to be wealthy in life, avoid divorce, and man, you're 90% of the way there. That is a wealth killer there. Navigating college, buying, selling. Are you going to do that? Are you going to rent? Are you going to do whatever? How do I set up? How much money do I need for retirement? Lots of things there. And you this is just a forecast. You've got time. You can look at Yeah, you could get opinions from these people. Most of the stuff is out there. Maybe Fidelity's not the one. I don't know. But there's just a wealth of information that's out here from different companies, and they all want you as their customer. So they're trying to be, the one site with all the information. And in fact, these guys even jump into crypto and stuff. And they all have very, very, professional sites. And they make things quite easy for you. You don't have to give them all your information or sign up, but you can try it. They are trying to get people to have sort of these digital, that's not for me. I would rather get advice from a specific company. So let me show you something else too. Let's say we talked about stocks and mutual funds, and I talked about how mutual funds, why they might be one of your best investments. So here's kind of the overview, and then they're going to go down through. But obviously mutual funds they're at the top of their list. Exchange traded funds, very close to mutual funds, and then individual stocks, CDs, cash investments. But let's go into mutual funds. Vanguard, because these people, they don't want you going to one site for one fund and another site for another one. They'd rather you buying their products. But now let's look at everybody's products. And here's some of that information, where do you even start on this? This is just a whole list of the funds that they have. But what you want is, if I had a bunch of money right now and I was just jumping into this, I would probably go to Morningstar. Now, if you've got an account with one of those mutual fund companies, because I can't spell Morningstar anyway, rather than pay for their service, I would probably get it through the company. But if you're a student or whatever and you don't mind giving away your email information, you can get a free trial. But these guys, they're a fee for service kind of thing, and they're not selling the mutual funds. They are just giving advice and rating the mutual funds. So it's kind of cool. If you're in Vanguard, you might pick a company, and this is just an alphabetical list, so this is kind of goofy. Let's see if I can find a specific mutual fund that I would be interested in. I'm just going to look at Vanguard stuff because I think they are going to do a better job of, and they're all going to have these flashy, marketing names, and it's going to make it all sound perfect. But you can see, this is Vanguard's own mutual funds. There are so many. They have 264 of their own companies' offerings. And you could, money markets, total stock market index. I don't want a market one. Target retirement. Sometimes they'll do this. You may say, hey, I know what I'm going to do. I'm going to pick a fund that I'm going to retire, let's say, in 2065. And this fund is set up for that. It's going to be a life cycle fund, which means, we'll talk more about this when we get into mutual funds, but it's going to change the underlying assets under the stock portfolio to match the segment of life that they think I should be in. You can see right now they are not happy. You lost 20% last year. Ouch. So that's what I'm saying. Are we at the bottom? I don't know. But it ain't good. But anyway, underlying asset mix. But it adjusts it to maximize itself at 2065. The concept being that when you're young, you should be involved in probably smaller, higher risk kind of companies, that are higher growth because you can accept a few failures now and then. And as you get older, as you're, as we're, God forbid, out in 2060, it's probably going to move to some very conservative investments to sort of stabilize things because you can't afford volatility at that point. But these guys, I don't think they're selling a lot of stock right now. Anyway, but in terms of choosing a fund, it's not as daunting as it would appear. You could do it a number of ways. If you go with highest rated Morningstar fund, sometimes you'll be looking at something that's had a great year last year but may not repeat it. Fund ratings and research. But this is where I'm talking about. If you get some hot tip on some mutual fund or a hot tip on some stock, you need to back it up with a little bit of research. Mid cap, small cap. Mutual funds can be made up of so many different items. They're not going to give you a lot of information without getting some of your information, which will in turn be sold to some of the brokerage companies, or maybe they'll just be looking for you, to become one of their customers. But the information is out there. But when I'm getting back to the paper, if you go to the paper and you look at the life insurance and on between the book and some of the lectures, you would have some information on life insurance, and you might say, I plan on getting a term or a whole life or whatever type of policy. I anticipate having, these sorts of responsibilities, and this might be the type of policy I would need. And again, it's just a forecast, and you're not using your own information. You're just using theoretical information. You're going to, in the paper, kind of demonstrate that you have an understanding of why tax deferred is probably a tax deferred investment is probably something you'll be utilizing, and then just do it. Just kind of get started. It should not be that hard, but then again, it will be a little bit hard but it's going to have to be done at some time. And I'm just saying to put it together on a paper now and kind of get you may not have the perfect paper. You'll probably still get a good grade, but the big picture is this will not be the first time you're thinking about it, because you're going to have to figure this out at some point in your life. And if you at least have a template and a basic understanding of the terms, and then you start dabbling a little bit, buying some mutual funds, and if you desire, maybe even buying a little bit of stock with a small amount of money, it's dead easy. They won't necessarily show you in here. Yeah, they want me to log in, but all my financial data would be out there, which would be a bad thing. But I can show you on this site how I bought some stock the other day. THMO, probably not the best investment right now, and penny stocks are probably not what you want to be doing. But this is where I'm at, because I was a little bored, and I saw it take that massive dive, and I decided to jump in. The company has done better in the past, and so potentially could it jump up? Maybe so. But what I want to illustrate here is the value of the charting data versus that tabular data that we were looking at that the book had on the slides. There's just so much more information available. You still get the open, the close, the 52-week high, the 52-week low, but now I can make a lot more sense out of this chart. And, if I was only looking at a newspaper, there's no way I'd buy this. But from here, I'm going, wait a minute, this stock was trading for $36 a couple years ago, and supposedly they've got something coming. If it gets above $1, that's a 10 bagger. I'm pretty happy with that. I'm not giving investment advice, but I'm just saying, and I didn't put in a bunch of money in this. This is not, the main part of my investment portfolio. But let me show you another stock. Shopify is a little more mainstream. This stock had a split. Oh, well, actually, they did a backwards split, a 10-to-1 type thing. So when I bought this stock, it was actually, in these prices, it was a 10-to-1 thing. So this would be $341. That price had actually been up at $1,500 quite some time ago. Let's look at the price here. So you can see that high tech, they don't like interest rates. High tech, they didn't like any of this. So they were doing quite well. And so, it got up to what they're showing here is $169. So that was actually trading for $1,690 a share. And now, factoring the split, it's been on as low as $290 a share. But I bought some way back here, and I sold a bunch somewhere up in here. I made a bundle. But anyway, it's all in the timing, and this is not for the faint-hearted. So they do, they're a big e-commerce thing, Canadian company. But you can do quite a bit of information. Lululemon. Am I going to Lululemon or the stock? I want to see the stock. I should have typed it in their actual site. Well, let's see where this takes me. I think everybody's familiar with the company. Again, not being in the tech sector, but retail kind of got beat up a little bit with COVID. Coming back. Although it's a Canadian company, Shopify also, I believe, is Canadian, but you can buy it on the exchange. Do I care what exchange it's traded on? It doesn't even say, does it? It's transparent to me. Not a big factor. It's traded on NASDAQ. I'm sorry. It's right there. But also, if there's a big change in price, this is free news. What's going on? Some analysis. Yahoo Finance. This isn't paid for analysis. CNBC. I think we're talking Kramer there, who just had to apologize. So things can get kind of dicey. You have to compare information, and you have to be aware that what the motivations are of the people offering information. I did own Under Armour at a certain point, but I'll tell you, how the rest of the industry. If Lululemon was way down in price, but I look at the competitive, the other players in that market, not that these are a perfect match, but Under Armour is probably pretty close, and I see that they're down as well, I'm not as concerned. If I see Lululemon's down individually, I might have a problem. Financials. I could look at some of their information. Looks like things are going well here. Net cash. But you have to kind of know what you're doing. You have to compare it to somebody else. They did beat their earnings. You can expect when they miss that there's going to be a drop in the price. And then some of these generic questions, that is not useful on the internet. You're not going to find that fidelity of information. But you have so much information available to you that you might be able to make heads or tails of it. But anyway, that's where I'm saying that the old newspapers and looking up stock quotes is not, it's just completely outdated. You can look across time spans and see, what the price has been from a particular date. The charting data is just so much more useful. The life of the company. So back here, $14 in 2007, and it got up as high as, quite a bit there. So anyway, I think you may find this stuff interesting. To get in there and kind of dabble in it a little bit, I think it's useful. I think it'll help you out, even if you stay on the porch and just stick with your mutual funds. But to understand how stocks work, how things affect a company, and buying companies maybe that you see out there that you know a little something about, and then to back it up with other people's opinions and be able to look at the financials. There's a lot of information out there. And the good thing about stocks is you can all win. If I'm buying a futures contract, I'm betting against somebody else who's speculating, who has the exact opposite opinion that I do. The good thing about stocks is that we can all invest and we can all go up together, or we may all go down together. But for me to buy a futures contract or even an options contract, I always second guess myself, because I know that if somebody's selling a futures contract, they have the same information I have, maybe better information, and they think the exact opposite, which scares me, because that's not, I don't trade for a living. So with stocks, sometimes you can get some good information and it may be valuable. And if you know, but I have no doubt that if we were looking at a 10-year chart, that this thing is going to be back up here. And I'd be very remiss if I was holding Lululemon to be getting out on a what I would think is a blip. If you look at the long-term stock market charts, it's pretty much a positive vector, going up by about 10%. So these bad financial times that we're having right now hopefully should be just temporary. All right. I've kind of rambled a little bit, but I think you've got an idea maybe on the term project. The big thing is to jump in there and do it. If you have concerns that it's not, you don't think it's going to be the right format, if I see that you've made the attempt to really try and sort it out, that definitely counts for something, because you're not going to get there all at once, but the closer you do get to examining all these issues, the better off you're going to be. Man, an hour 42, that is way too long. But I think we talked about a lot. I appreciate it. You don't have to watch this all tonight. And whatever. Sorry. Wow, that's long.